Attention taxpayers, the IRS released its updated inflation-adjusted tax brackets for 2026. Even small adjustments to the tax brackets can potentially change your tax bill by thousands or even tens of thousands of dollars or more depending on your income. So today I'm going to break down exactly what the new tax brackets are and how these updates can affect you. Without further ado, let's dive in. Let's talk about how do tax brackets work. Before we jump into the new tax brackets, I need to quickly explain how tax brackets work because many people actually get this wrong. A lot of people think that all their income is taxed at one rate, like 32% or 35%. That's not true. Your income is divided into portions, and each portion is taxed at a different rate. The first part is going to be taxed at 10%, the next portion is at 12%, the next after that is 22%, and so on. As your income goes up, only the money in the higher brackets is taxed at the higher rates. This is called a progressive tax system, and it's what we have here in the United States. Every year, the tax brackets are adjusted for inflation. Now that we've covered how tax brackets work, let's go over the new tax brackets for 2026. All right, guys, let's start with single filers. Here are the new tax brackets for single filers for 2026. If your income is $12,400 or less, you fall into the 10% tax bracket. If your income is $12,401 to $50,400, you're now in the 12% tax bracket. If your income is between $50,401 all the way up to $105,700, the income that's in this bracket will be taxed at a rate of 22%. If you have income from $105,701 to $201,775, that income would be taxed at the 24% tax rate. If you have income from $201,776 to $256,225, you're in the 32% tax bracket. If your income falls between $256,226 all the way up to $640,600, you will be in the 35% bracket. And finally, if you have income above $640,601, that income will be taxed at the top rate of 37%. All right, guys, now let's move to the new brackets for people who filed married filing joint. Here are the new brackets for married filing joint individuals. If your taxable income is $24,800 or less, you will fall into the 10% tax bracket. If your income is $24,801 to $100,800, you will fall into the 12% tax bracket. If your income is between $100,801 to $211,400, you will fall into the 22% tax bracket. If you have income from $211,401 to $403,550, as a married couple, you will fall into the 24% tax bracket. And if your income is $403,551 all the way up to $512,450, you will be in the 32% tax bracket. If your income falls between $512,451 all the way up to $768,700, you are officially in the 35% bracket. And last but not least, if your income is above $768,700, you will fall into the highest tax bracket of 37%. Okay, now that we covered married filing joint, let's talk about the changes to the standard deduction. In addition to the tax brackets, the IRS has also updated the standard deduction amount. If you're not familiar with the standard deduction, it's the dollar amount the government allows taxpayers who don't itemize to subtract from their taxable income. For the 2026 tax year, the standard deduction for single filers will increase to $16,100, up from $15,750 in 2025. For married couples filing jointly, the deduction rises from $31,500 in 2025 to $32,200 in 2026. Now, before we move on, I got to remind you guys that my Tax-Free Millionaire Summit is right around the corner. Spots are disappearing quickly. So over these 3 days, I want you to know I'll teach you every cutting edge strategy that I've learned. I'm going to cut your tax bill by 50 to 100% using real estate strategies, income shifting techniques, entity structuring secrets, and much more. This is your chance to finally take control and start creating lasting tax-free wealth for you and your family. Click the link in the description below to grab a spot. Now back to this video. As I mentioned earlier, the IRS adjusts tax brackets to account for inflation every year. You probably noticed that the prices of homes, groceries, gas, clothing, and cars keeps creeping up. This is inflation in action. According to the Consumer Price Index, inflation in 2025 averaged around 2 to 4%, though many people argue that the real inflation they feel in their day-to-day lives is a lot higher. The IRS adjusts the tax brackets to prevent what's called bracket creep. And without these adjustments, even if your income stays the same year over year, inflation could push you into a higher tax bracket, meaning you'd pay more taxes simply because the dollar is worth less. Now, by adjusting the brackets, the IRS ensures that you're only taxed more when your real income, your purchasing power, actually increases. So what this means for you in 2026 is that you need to earn slightly more income to move into a higher tax bracket compared to 2025. For many people, this is great news. Those earning the same as last year may now fall into a lower marginal tax rate, reducing their their overall tax burden without any changes to their lifestyle or spending habits. From a fairness perspective, this makes perfect sense to me. The same dollar today buys less than it did last year, so it wouldn't be fair to tax you at higher rates if your income hasn't truly grown in real terms. Adjusting brackets ensures your tax rate is more accurately reflecting your actual financial situation. It's also important to note that the standard deduction increases work hand in hand with these bracket adjustments. Combined, they can reduce your taxable income and save you money, even if your wages have risen slightly due to cost of living, adjustments from your employer. If you want to learn strategies to maximize these benefits and potentially reduce your tax liability under the 2026 brackets, make sure to book a free consultation by clicking the link in the description. Understanding how these adjustments work is the first step to smart tax planning. The bottom line for the 2026 tax bracket adjustments, let's talk about it. If inflation were 0%, there would be no need to adjust the tax brackets at all. But because the value of the US dollar naturally decreases over time as more currency enters circulation, and yes, the government keeps printing money, these annual adjustments are essential. So going forward, you should expect inflation to continue and the IRS to keep updating tax brackets each year. This is a good thing. It ensures that taxpayers are not unfairly penalized by inflation, and it keeps the system more equitable. Understanding tax brackets is also about understanding your broader financial picture. Higher brackets don't just affect your federal tax, they can influence planning for retirement contributions, investments, and other deductions. So by staying informed, you can make more strategic decisions to keep more of your hard-earned money in your pocket. That's it for today's video. As always, don't forget to like, comment, and subscribe for more expert tax tips and insights. I'll see you in the next one. Cheers.